Inventory accounting is a critical component of financial management for any business engaged in buying, selling, or manufacturing goods. The accurate tracking and valuation of inventory not only influence the calculation of cost of goods sold, COGS, but also play a significant role in determining gross profit, net income, and ultimately, the financial health and performance of an organization. Two primary systems are used to account for inventory: the perpetual system and the periodic system. Both methods serve the fundamental purpose of recording and managing inventory transactions, yet they differ significantly in their processes, advantages, challenges, and implications for financial reporting and decision-making. The perpetual inventory system is characterized by its continuous tracking of inventory transactions. Every purchase, sale, or return is immediately recorded in the inventory account, ensuring that the records always reflect the actual quantity and value of inventory on hand. This system relies heavily on technology, barcode scanners, point-of-sale terminals, and integrated inventory management software to update inventory balances in real time. As a result, businesses using the perpetual system can access up-to-date information about stock levels, COGS, and inventory turnover at any given moment. This immediacy facilitates better inventory control, reduces the risk of stockouts or overstocking, and supports more informed purchasing and sales decisions. In contrast, the periodic inventory system updates inventory records at specific intervals, such as monthly, quarterly, or annually. Under this approach, purchases are recorded in a purchases account, and no adjustments are made to the inventory account until a physical count is conducted at the end of the period. The cost of goods sold is then calculated by adding purchases to the beginning inventory and subtracting the ending inventory, which is determined through the physical count. While the periodic system is simpler and less costly to implement, especially for small businesses with limited resources, it provides less timely information and may expose companies to greater risks of inventory shrinkage, errors, or mismanagement. The choice between perpetual and periodic systems has far-reaching implications beyond the mechanics of record-keeping. For instance, the perpetual system's real-time data allows management to detect theft, spoilage, or other losses quickly, enabling prompt corrective actions. It also supports advanced inventory management strategies, such as just-in-time (JT) inventory, which require precise knowledge of inventory levels. On the other hand, the periodic system's reliance on periodic counts can result in outdated or inaccurate inventory information, potentially leading to stockouts, excess inventory, or undetected losses. From an accounting perspective, the differences between the two systems become evident in the journal entries recorded throughout the accounting period. In the perpetual system, every inventory-related transaction, purchases, sales, returns, allowances, and discounts, is directly reflected in the inventory account. For example, when goods are purchased, the inventory account is debited. When goods are sold, the COGS account is debited and inventory is credited for the corresponding amount. This ongoing updating process ensures that the balance in the inventory account always matches the physical inventory on hand, barring any unrecorded losses. Conversely, in the periodic system, purchases are recorded in a separate purchases account, and the inventory account remains unchanged until the end of the period. Sales are recorded without reference to COGS during the period. At the end of the period, a physical inventory count determines the ending inventory, and adjusting entries are made to close out the purchases account, update the inventory account, and calculate COGS. This batch processing approach streamlines day-to-day bookkeeping but delays the recognition of inventory changes and COGS until the period-end adjustment. The selection of an inventory accounting system also affects financial statement presentation and analysis. Under the perpetual system, the inventory balance reported on the balance sheet is always current, providing stakeholders with an accurate snapshot of the company's assets. The COGS reported on the income statement reflects the actual cost of goods sold during the period, enhancing the reliability of gross profit calculations. In contrast, the periodic system's reliance on periodic counts means that the inventory and COGS figures may be less precise, particularly if there are significant discrepancies due to shrinkage, spoilage, or unrecorded transactions. Moreover, the choice of system can influence key financial ratios and performance metrics. Inventory turnover, days in inventory, gross profit margin, and working capital ratios all depend on accurate and timely inventory data. Businesses that require tight inventory control, such as retailers with high-volume, low-margin operations, often prefer the perpetual system for its ability to provide granular, real-time insights. Manufacturers, distributors, and companies with complex supply chains also benefit from the perpetual system's detailed tracking capabilities, which support production planning, order fulfillment, and demand forecasting. Despite its advantages, the perpetual system is not without challenges. Implementing and maintaining a perpetual inventory system requires significant investment in technology, staff training, and process integration. Errors in scanning, data entry, or system configuration can lead to discrepancies between recorded and actual inventory levels. Additionally, while perpetual systems provide continuous records, physical counts are still necessary to verify and reconcile inventory balances, address shrinkage, and ensure the integrity of financial statements. The periodic system, while simpler and less resource-intensive, may be suitable for small businesses with limited product lines, low transaction volumes, or minimal inventory turnover. However, as businesses grow and operations become more complex, the limitations of the periodic system, delayed information, increased risk of errors, and lack of real-time visibility can hinder effective inventory management and financial reporting. Many organizations initially adopt the periodic system, but transition to the perpetual system as their needs evolve and technology becomes more accessible. Inventory valuation methods, such as first in, first out, FIFO, last in, first out, LIFO, and weighted average cost, WAC, can be applied under both perpetual and periodic systems, but the results may differ. For example, under the FIFO method, the cost assigned to COGS and ending inventory will be the same in both systems if prices are stable. However, under LIFO or WAC, the timing of purchases and sales can lead to variations in COGS and inventory values between the two systems. The perpetual system applies the chosen valuation method to each transaction as it occurs, while the periodic system applies it at the end of the period based on aggregate data. Technological advancements have increasingly blurred the lines between perpetual and periodic systems. Modern enterprise resource planning, ERP solutions, cloud-based inventory management platforms, and integrated point-of-sale systems have made perpetual inventory management more affordable and accessible to businesses of all sizes. These tools automate data capture, streamline processes, and enhance accuracy, reducing the administrative burden associated with manual record-keeping. As a result, the perpetual system has become the standard for most medium to large enterprises, while the periodic system is now primarily used by smaller firms or those with limited inventory complexity. Internal controls are essential in both systems to safeguard inventory assets, prevent fraud, and ensure the accuracy of financial records. In the perpetual system, controls focus on the accuracy of transaction recording, system security, and periodic reconciliation of physical and recorded inventory. In the periodic system, the emphasis is on securing inventory during storage and handling, conducting thorough physical counts, and reconciling discrepancies promptly. Regardless of the system used, regular audits, segregation of duties, and robust documentation practices are vital to maintaining the integrity of inventory accounting. Tax considerations also play a role in the choice and implementation of inventory accounting systems. Tax authorities in various jurisdictions may prescribe or favor certain inventory valuation methods or require specific documentation to support reported inventory balances and COGS. The perpetual system's detailed transaction records can facilitate compliance with tax regulations and support audit requirements, while the periodic system may require additional documentation to substantiate inventory values and adjustments. The impact of inventory accounting extends beyond the finance department, influencing operations, procurement, sales, and customer service. Accurate inventory records enable businesses to optimize stock levels, reduce carrying costs, improve order fulfillment, and enhance customer satisfaction. Inaccurate or outdated inventory data can lead to missed sales opportunities, excess inventory, increased obsolescence, and cash flow challenges. Therefore, The selection and effective management of the inventory accounting system are strategic decisions that contribute to overall business success. In summary, the perpetual and periodic inventory systems represent distinct approaches to tracking and managing inventory, each with its own strengths and limitations. The perpetual system offers real-time visibility, enhanced control, and improved decision-making capabilities but requires greater investment in technology and processes. The periodic system is simpler and less costly, but may expose businesses to greater risks and limit their ability to respond to changing market conditions. Advances in technology have made perpetual inventory management increasingly accessible, prompting many organizations to adopt this approach as their operations grow in scale and complexity. Ultimately, the choice of inventory accounting system should be guided by the nature of the business, the volume and complexity of inventory transactions, available resources, and the need for timely and accurate information. By understanding the differences between perpetual and periodic systems and aligning inventory management practices with organizational goals, businesses can achieve greater efficiency, profitability, and competitiveness in today's dynamic marketplace.